Hi, in this video, we'll conclude the efficient market hypothesis with the strong form here. So we have the semi-strong form already, so there must be some sort of strong form, which means private information cannot lead to consistent alpha. Okay, so even private information that is not public will not give you consistent alpha. If that's the case, then we can say it's a strong form efficiency here. So the market here, the financial market, is in strong form market efficiency. So which means insider trading here is not profitable if you're in pursuit of consistent alpha here. So insider trading is useless here. Okay, so there's no alpha even with insider trading. So as its name suggests, insider trading means those who are inside of a company, likely top management or the board of directors, they're likely to hold more information for this company than the outsiders who are not working or who does not own a share of this a great share of this company. If they know more about the information, especially about its future. So remember, we're always buying the company because of its future in cash flow, right? So if the insiders know more information about its futures, for example, if they know there's going to be an acquisition or a merger coming in the next 2 or 3 months, they can act on this insider information, and they could buy in a lot of stocks, more than they have currently. So if they wait until that that event, likely a merger or acquisition, actually happened, they can make a huge amount of abnormal profit from it. Okay, that is because of insider information, and the outsiders do not know it. Okay, so they'll still be trading as usual. Yeah, they will be getting the benchmark expected return, and they wouldn't buy or sell because they don't have that information. They're still getting public information, right? So how do we know if if the market is in strong form efficiency here? We're still going to use a time horizon like this. Okay, so let's say or assume there's a firm here. Okay, so its return somewhere around the benchmark return here, so no abnormal return. Okay, and then at some point in time there's a major event, be it an acquisition or a merger, and after that event has realized, the return is going to be higher than the original benchmark return, so somewhere here. Okay, so with semi-strong form we should see something like this, right? We should see something like this. But what if even before the actual realization of the mergers and acquisitions or that specific event, we see some of these returns drifting upwards, and then it goes like this. Okay, so even before the event has happened, that return is consistently going up. This could be a sign of insider trading, or it could be a sign of very great anticipation, right? So it's very, very difficult for us to distinguish between whether it's just insider trading or it's just market anticipation. So it takes a lot of expertise to really distinguish that. But in this case, we could say there's a possibility of insider trading. And the bad news is the inside traders are not always caught, okay, in reality. So it's very time consuming, and it's very difficult to prove that there are insider tradings. So, but if we can see this drift before the announcement of the events, we have reasonable grounds, or we can have reasonable doubt for insider trading. And if that's the case after investigation, then we can say the strong form market efficiency is violated in this case, because if we have strong form, then even insider trading would not give you any positive or consistent alpha. Okay, so we should still see something like this. The price will shoot up instantly, and because of the information has been incorporated into the price. So with insider trading, it shouldn't be profitable. Okay, and of course, in reality, do we see many strong form markets? That's going to be very unlikely. Okay? It's going to be very unlikely. Insider trading still exists in many different markets at different levels, and again, they are very difficult to detect and to be proven. Okay, but still, theoretically, if insider trading is not profitable, if the market is very transparent, if the supervision or if the laws and regulations hold, and the people there behaves in such in an upright way, they do not trade in an insider way, then you could argue there could be some strong form market efficiency there. But in reality, it's very rare. Okay, and that's the end of the efficient market hypothesis. So remember, there are three different levels. Okay, the weak form, the semi-strong form, and the strong form, and they correspond to three types of trading techniques. So for the weak form, the technical analysis shouldn't give you any consistent alpha. So for the semi-strong form, the fundamental analysis shouldn't give you any consistent alpha. And for strong form, even insider trading cannot yield a consistent alpha. Okay, and that's the three different levels for market efficiency here. I'll see you in the next video.